Dear viewers, the global business landscape is full of stories that create lasting impressions and become famous case studies. Southwest Airlines is one such case. Let us travel back to the US airline industry in the 1970s. It was brutal, cutthroat competition leading to thin margins, players desperately trying to outfill each other with fancy lounges, meals, and perks that cost more than they brought in. And then entered a small airline in the arena with a very unconventional approach. What if we stop trying to look like everyone else? What if we simply fly more often, faster, cheaper, and focus on what people truly value? So they threw the frills away, literally. No elaborate lounges, no fancy meals, no confusing seat classes, just quick, convenient, and affordable flying. In an industry obsessed with hubs, Southwest quietly built a point to point network across mid sized cities that bigger airlines didn't care about. The result: shorter flights, happier passengers, lower cost, and a brand new market of people who had never flown before. Car travelers who suddenly realized that travel could be at the speed of the plane and at the price of a car. Southwest didn't just take market share, it created a new market, and that is the heart of what makes great companies great. They don't fight in the crowded red oceans, they sail into blue ones. Red ocean implies a mature market with intense competition. Ocean as saturated waters with sharks where everyone is attacking each other and turning the waters red. Blue ocean, on the other hand, is an unexplored marketplace. When we investors hear blue ocean, we often think of flashy startups, the Olas, Zomatos, and Airbnbs of the world. Brilliant ideas? Yes. But most of these are powered by deep pocketed venture capital and often miles away from sustainable profitability. Very few companies manage to create a blue ocean without burning billions. And this is where something fascinating comes in, something that I've spent years tracking as an investor: optionality. These are the tiny seeds that companies plant quietly, which sometimes grow into giant value engines. Optionality is tricky. You can't forecast it on spreadsheets, you can't model the upside at the beginning. Yet, when it works, the payoff could be non-linear, the kind that turns good companies into extraordinary ones. Take Infoedge. Its core Naukri business was already strong, yet it backed platforms like Zomato and Policy Bazaar long before the market understood their potential. That optionality bet created massive value as these entities got listed. Or take one of my favorite recent examples, Shaily Engineering. A few years ago, Shaily was best known as a reliable plastic component manufacturer with IKEA as its anchor customer. A comfortable place to be, but not extraordinary. Then came its bold, big gestation bet: drug delivery devices for global pharma companies. This was a regulated field needing complex and precision engineering and a long gestation period. Exactly the kind of optionality that tests management conviction. Today, that drag has become the company's growth engine, powering its work in GLP-1 therapies, insulin delivery, migraine treatments, and more. In some of these, Shaily is the exclusive device supplier. As markets woke up to this shift, the stock re-rated sharply, and the healthcare is now on track to contribute half the company's revenue in the next 3 years. This is a classic optionality story unfolding in front of us. So, where else is this happening? Which listed Indian companies are quietly planting the seeds that could change their future? One name that jumps out immediately is Sangvi Movers, Asia's largest and world's fifth largest grain rental company, which is deeply entrenched in sectors like wind energy, infra, cement, power mining, infra, and construction segments. The company is financially disciplined with net debt to equity at 0.36 times and return ratios at 16% and above, with its stock commanding a PE or price to earnings multiple of 17 times. But the real story is happening outside India. The company has begun expanding into Saudi Arabia, a market where over $2 trillion of construction, giga projects, mining, utilities, and global events are planned under Vision 2030. It's an underserved market, high demand, huge scale. And Sangvi wants to become one of the top 3 players over the next 5 years in Kingdom of Saudi Arabia. Will it involve upfront investments and gestation? Yes. Will the returns dip temporarily? Possibly. But if this optionality plays out, Sangvi could unlock a new growth curve, just like Infoedge did with Zomato and Shaily did with healthcare. And that's what makes optionality so irresistible. Affordable risk, disproportionate payoff in case it plays out well, and a chance to rewrite company's destiny. In the coming days, I'll share more about optionality driven opportunities that I'm tracking, including one that I believe are being massively underestimated by the markets right now. Until then, keep your mind open because the biggest wealth creators rarely look like winners when they are just stepping on optionalities. Please note that no stock view is implied through this video. It is purely for informational and educational purposes. Hope you found this information useful. Thank you for watching. Goodbye.